Well, COVID's certainly not the only thing weighing on investors. Let's now turn to the economic conversation in the U.S. We, of course, have the Fed minutes on tap later this afternoon, and we've got Tom Simmons, Jefferies money market economist. Tom, good to talk to you today. Where do things stand right now?
Hey, good morning. So the economic data has been really mixed recently, and today was another perfect example of that, where some signals were reasonably strong, or I guess more solid is probably a better way to put it, and others look quite weak. You mentioned the jobless claims data that came out this morning. 240,000 is the highest we've had in at least, I think, 2 or 3 months on claims. So it seems like we've seen some sign that the labor market tightness that has been the hallmark of the economy for the last year or so, probably peaked in August or September of this year. So we're going to continue to see claims kind of gradually grind higher in the next couple of months.
Yeah, so we're certainly just talking about 1 week, but it points to the right direction. You look at the latest inflation print, CPI, PPI, both showing a bit of a cooling there. What more will it take, you think, to convince the Fed that they can, in fact, slow down those rate hikes?
So I think that there's been this, kind of theme out there that as we've seen economic data come off of these really strong peaks, that it suggests that the Fed has done enough and that that it's okay for them to take their foot off the gas, so to speak, with rate hikes, and that inflation is naturally going to come down lower. I think that there is a certain amount of excess inflation that will come off based on what the Fed has already done to this point and how much the economy has weakened. But they really, I think, do need to continue with more rate hikes into the beginning of 2022 or 2023, excuse me, and maintain that high level like they've been saying in their recent speeches. We actually need labor market data to continue to soften, because even though jobless claims are a little bit higher and we do have a lot of anecdotal evidence of rather large layoff announcements from big companies, the unemployment rate is still very, very low. And the claims levels that we're seeing are not consistent with bigger increases in unemployment. So long as unemployment remains very low, we're still going to have this wage pressure that's going to be driving a higher than target inflation level, and the Fed needs to address that with higher policy rates.
When you say a certain amount of inflation can come off based off of policy implemented already, what are we talking about?
Right. So, I mean, we're not looking at inflation in this sort of 7, 8, 9% year over year rate any longer. We're probably on track to decelerate. So say the CPI, would head down to like a 3.5 to 4% level based on what's gone on now. And that's certainly a lot of progress from the peak, but it's also significantly higher than 2%, which is what they're shooting for.
And you say, certainly necessary for the labor market to cool off even further. We got more announcements yesterday, HP laying off thousands of additional workers. I mean, this has largely been concentrated in the tech sector. It feels like the spillover is starting to happen into some of the legacy names as well. Does this mean we're going to see more of this to come in the months ahead?
So I think so. It's clear that the tech sector and some of the sectors that just grew like out of control in the sort of post-lockdown recovery are the first that are starting to see the bigger sort of areas of weakness, right? But we also have evidence in some other economic data releases that suggested there's really uneven demand across the labor market. So while we see big tech companies laying off lots of workers, you also see the NFIB reporting that small businesses still have a lot of open positions to fill. And they've really been the driver of these increases in job openings we've seen in the JOLTS data recently as well. So obviously, it's not necessarily the case that someone who's laid off from one of these big tech firms is going to find a job very quickly at a small business, but certainly some of them will. I don't think that this dichotomy can last forever, especially as we progress through longer and longer periods of time where interest rates are so high. But at least for now, I think that should provide some comfort that the labor market can kind of hit a more gradual sort of glide path. I don't want to necessarily use the word soft landing, because I do think that it is going to deteriorate significantly over time. It just, again, suggests that the pace of that deterioration is going to play out over, several quarters rather than several months, say.
That was just my question, Tom, whether a soft landing is still in play, but it sounds like you think it's still a muddled picture.
Yeah, I mean, I think a soft landing is a rather difficult concept to define. So our view is that we are going to see some pretty significant slowing in growth. We do think that we're going to be heading into a recession next year that's going to be rather lengthy, something like 5 or 6 quarters starting in the middle of next year. But we're not expecting really deep negative growth rates over that period of time. Again, also, we don't expect that the unemployment rate is going to shoot dramatically higher from here. We just think that it's going to rise to something like around 5.5% as it peaks out. That's a level that used to be considered pretty good. So is that a soft landing? In some definition, it is, but it's also significantly weaker economy than what we've been used to for the last 18 months.
Thomas Simmons, Jefferies money market economist. Good to talk to you today. Have a good Thanksgiving.
Thank you. You too. I appreciate it.